Assalamualaikum dan salam sejahtera. I hope everybody are clear with part 1 on space market. Now let's continue to part 2, which is real estate assets or property market. What's the difference between physical and financial capital in the real estate market? Financial capital is basically used to purchase physical capital asset. Hence, the real estate space markets deal with physical capital, and the real estate asset market deals with financial capital. So now we will concentrate on financial capital as an investment in the real estate market. Asset markets are not segmented like the space market. Why? As the capital for this market is financial capital or money, it is fungible and very mobile, where any factors that happen in the market at micro or macro level would have some effect on the financial capital. For the space market, where it relies on physical capital that is specific and relatively immobile, so that it can be segmented into types or location-based. Okay, now look at these illustrations. Similar with the space market, there are supply and demand in the property markets. However, both are coming from investors, where in the supply side, there are investors that wanted to sell the real property or property asset, and in the demand side, there are investors that wanted to buy or invest into real estate properties. The intentions of both parties is basically to gain some profit now or in future, as they are investors. And the main target of both sides actually the incomes that the asset can generate, or called as cap rates, which is capitalization rate. Let's proceed to the next slide on the example of cap rates. Cap rate is the ratio of net operating incomes to asset value. In this example, asset would represent a house. Let's say the house is sold with 400,000 value with a cap rate of 8%. It means 8% over the value of the house, which is 400,000, equal to 32,000. This 32,000 is the incomes or profit that the property able to generate to the investor. Usually in a normal circumstances, property like house, building or land would have a positive cap rate. Property like car or other vehicles would have a negative cap rate, which is decline in value. That is why many people have advised that the first property that you should buy when getting a job or have enough money is house, not a car. Even though majority of us nowadays are trapped with a loan or financing system to acquire property, we should have enough knowledge on financial aspects as well as should think twice before making decisions related to debt creations. Based on Insolvency Department of Malaysia, more than 300,000 bankruptcy cases is reported as of December 2018. And the main causes of bankruptcy were personal loans and hire purchase vehicles. Therefore, we need to be wise when it comes to decide to buying property by debt creation. If we manage to buy property on cash, that's a very good. Still need to think what the property we want to buy, on what purpose, which location, what is the cap rate of that property in future. In other words, the asset price is equal to current annual net incomes divided by cap rate. What are the major determinants of cap rates? Three major determinants of cap rates. The first one is the opportunity cost of capital, or OCC. This comes from the capital markets. It represents how much return can investors expect to earn in other types of investments like stock, bonds, or money market if they choose to invest in certain asset, in this case financial asset. or real estate asset. Higher real interest rates or higher expected returns in other types of investments will require higher expected returns in real estate and therefore higher cap rates, other things being equal. Second is growth expectations in the assets or property future cash flow. This comes from the space market. It represents how much can investors expect that this property's net cash flow, which is rent minus expenses, will be able to grow over the coming years. Higher or realistic growth expectations will allow a lower cap rate as investors will be willing to pay more ringgit Malaysia today for a given amount of current net incomes in order to own the property, since this income is expected to grow. And finally is risk perceptions and preferences among investors regarding the assets or property. This comes from both the space market and the capital market, which is risk is relative. How risky is an investment in this property and how much do investors care about that risk? And also, the greater risk and greater sensitivity to risk will require higher cap rates or lower asset values per ringgit Malaysia of current income. For investors, real estate assets must be able to generate future cash flows or cash. What is cash? Cash is fungible. Fungibility is the ability of a good or asset to be interchanged with other individual goods or assets of the same type. Real estate assets compete against stocks and bonds. The real estate asset market is part of the broader capital market. What is capital market? Capital market is a market where buyers and sellers engage in trade of financial securities like bonds, stocks, and others, and the buying and selling is undertaken by participants such as individuals and institutions. Capital markets help channelize surplus funds from savers to institutions, which then invest them into productive use. Generally, this market trades mostly in long-term securities. Financial securities, also referred to as financial instruments or financial assets, is a generic term used to describe stock, bonds, money market securities, and other instruments representing the right to receive future benefits under a set of stated conditions. Major types of capital asset market and investment products. Capital market consists of primary markets and secondary markets. Primary markets deal with trade of new real estate assets or financial assets like issues of stocks and other securities, whereas secondary market deal with the exchange of existing or previously issued assets or securities. Another important division in the capital market is made on the basis of the nature of assets or security traded, which are equity market, debt market, and derivative market. What are equity and debt market? What the difference between these two? Equity market or the stock market is the arena in which stocks are bought and sold. The term encompasses all of the marketplaces such as the New York Stock Exchange, the Nasdaq, the London Stock Exchange, and Bursa Malaysia. In real estate equity market, it may represent an ownership towards a real property. Equity or stock represents a share of ownerships of a company. The owner of an equity that we call shareholder would have a voting right in the company and would get profit from dividends. Dividends are the percentage of company profits returned to shareholders. The equity holder may also profit from the sale of the stock if the market price increases in the marketplace. The owner of an equity can also lose money. In the case of bankruptcy, they may lose the entire stake. The equity market is volatile by nature. Shares of equity can experience substantial price swings, sometimes having little to do with the stability and good name of the corporation that issued them. How about debt market? Debt market or credit market is a financial market in which the investors are provided with issues or bonds and trading of debt securities. Debt instruments are assets that require a fixed payment to the holder, usually with interest. Bondholder can be regarded as creditor of the company and the interest paid would provide steady income to the investors. They are non-eligible to vote in the company as no ownership given to them. This type of investment is more secured when in case the company suffers from losses. It will not affect the investors. These are examples of equity and debt asset. It can be divided into public and private markets. Equities offer considerable potential for capital growth and are long-term risk investments. Examples of equity assets in the public markets are stocks or shares, represent the proportions of ownership in the company, while stock is a simple aggregation of shares in the company. Shares are issued at par, discounts, or at premiums. The performance of the business can often be measured by the amount of dividends shareholders receive and by the price of the share quoted on the stock market. Shares are also commonly referred to as stock. The different types of shares which are traded on Bursa Malaysia include ordinary shares, preference shares, ordinary and preference shares. Ordinary shares, also called equity shares. This is the risk capital of a company. Ordinary shares give holders the right of ownership in the company, such as the right to share in the profit, the right to vote in general meetings, and to elect and dismiss directors. Obligations of ownership are also conferred, and this may result in the loss of investors' money if the company is unsuccessful. Ordinary shares usually form the bulk of a company's capital and have no special rights over other shares. In the event of liquidations, ordinary shares rank after all other liabilities of the company. And the preference shares, these are shares which carry the right to dividends, normally fixed, which ranks for payment before that ordinary shareholders. Preference shares may be preferred also as regards to distributions of assets upon dissolutions of the company. Preference shares generally carry no voting rights, but voting rights may be made contingent upon failure to pay dividends on preference shares for a certain period of time. Okay, second one is real estate investment trust or REITs. REITs is a key asset class in an investment portfolio. Typically, before REITs were introduced, an investor may invest in property stocks and or physical or landed property to get exposure in the real estate sector. Investors now have an option to invest in REITs by paying only a fraction of the real estate prices. In other words, REITs provide a way to invest in quality large-scale commercial real estate without having to buy the properties directly. REITs typically offer you a stable income stream and attractive distribution yields. REITs must comply with the requirements of the guidelines on listed real estate investment trusts by the Capital Markets and Services Act 2007 for listing on Bursa Malaysia. And mutual funds and also ETF or exchange traded funds. ETF and mutual funds have a lot in common. Both types of fund consist of a mix of many different assets and represent a common way for investors to diversify. ETF can be traded like stocks, while mutual funds only can be purchased at the end of each trading day based on a calculated price. Mutual funds also are actively managed, meaning a fund manager makes decisions about how to allocate assets in the fund. ETF, on the other hand, usually are passively managed and based more simply on a particular market index. So far, are you clear with these equity assets or instrument in the market, the public markets? Okay, how about equity asset in the private markets? Known as private equity. It is an alternative investment class and consists of capital that is not listed on a public exchange. Private real estate equity is the real property itself, and private financial equity market is composed of funds and investors that directly invest in private companies or that engage in buyouts of public companies, resulting in the delisting of public equity. Institutional and retail investors provide the capital for private equity, and the capital can be utilized to fund new technology, make acquisitions, expand working capital, and to bolster and solidify a balance sheet. Investors in private equity are including public pension funds, corporate pension funds, insurance companies, high net worth individuals, family offices, endowment foundations, sovereign funds, and many more. In other words, private equity is an alternative form of private financings away from public markets, in which funds and investors directly invest in companies or engage in buyouts of such companies. Private equity firms make money by charging management and performance fees from investors in a fund. Now let's proceed. What are the examples of debt asset for public market? What is a debt instrument? A debt instrument is a tool an entity can utilize to raise capital. It is a documented binding obligation that provides funds to an entity in return for a promise from the entity to repay a lender or investor in accordance with terms of a contract. Now let's proceed. What are the examples of debt assets for public market? What is a debt instrument? A debt instrument is a tool an entity can utilize to raise capital. It is a documented binding obligation that provide funds to an entity in return for a promise from the entity to repay a lender or investor in accordance with terms of a contract. Debt instrument contracts include detailed provisions on the deal, such as collateral involved, the rate of interest, the schedule for interest payments, and the time frame to maturity, if applicable. A debt instrument can be in a paper or electronic form. Bonds, treasury bills, certificates, bills of exchange, and promissory notes are examples of debt instruments. Bonds Government bonds are fixed income securities issued to lenders of long-term loans with a maturity date. They provide returns in the form of fixed periodic payments. A government bond is a bond issued by a national government. Such bonds are most often denominated in the country's domestic currency. Exchange-traded bonds and sukuk. Bonds or sukuk have always been seen as an asset class to hedge when markets are bearish and a means to develop a steady incomes over many years. But in the past, the bonds or sukuk markets was accessible only to high net worth and institutional investors. The difference between bond and sukuk is for sukuk it comply with the Sharia principle. Okay, now with ETBS, all investors can have access to the bond or sukuk market with ease via the stock market. What are ETBS? ETBS are fixed income securities, also known as bond or sukuk, that are listed and traded on the stock market. ETBS are issued either by companies or government or the issuer to raise funds for their needs. ETBS have varying structures such as fixed rate, floating rate, and hybrids. For private debt securities, okay, so private debt securities are issued by corporations and or by financial or non-financial institutions that run the spectrum in quality and yield. Examples of private debt securities are corporate bonds. When corporations go to the capital markets to obtain money for all corporation purposes, the single most important sources of fund is through the sale of debt securities. It is a long-term written promise to pay a certain sums of money at a certain time for a specific rate of interest. Second one is mortgage. A mortgage is a loan against a residential property. It is secured by an associated property. In a case of failure of payment, the property can be seized and sold to recover the loan amounts. How about mortgage bonds? Mortgage bonds is a bond that is offered to a private in the private markets in order to acquire a certain property, okay, by an institutions. Debentures are not backed by any security. They are issued by the company to raise medium and long-term funds. They perform the part of the capital structure of the company, reflect on the balance sheet but are not clubbed with the share capital. Key points here are: in the equity market, investors and traders buy and sell shares of stocks or buy and sell of real estate property. Stocks are stakes in a company purchased to profit from company dividends or the resale of the stock. In the debt market, investors and traders buy and sell bonds. Debt instruments are essentially loans that yield payments of interest to their owners. And equities are inherently riskier than the debt and have a greater potential for big gains or big losses. That's all for this part. We'll continue with a real estate cycles and its strategic implications for investors in the next part. Thank you.